financial. Today, we've got a great panel. You can see them all on screen here. We might have one more joining as well. And of course, Mike Larson, as always, leading these conversations for The Money Show. So Mike, I'm going to turn it over to you. This is a fascinating market. Let's get right into it.
Awesome. Thanks, Gav. Thank you, everybody, for joining us here, and all the Money Show guests that are here as well. Sometimes when we plan these things ahead of time, I almost wonder if we're going to have something to talk about. You never know what's going to happen in the market. I don't think we have that problem today. It is truly an interesting time of year, truly an interesting time in the markets. And by markets, it's not just stocks. We're seeing crazy action in precious metals. We're seeing all this wild debate about AI boom, AI bubble. A lot of things to talk about, and a lot of developments on the interest rate front and cryptocurrency arena as well. So that's why we're trying to do this, get everybody together, share some insights. And of course, again, just to kick things off and remind you, if you're going to be joining us at the Money Show Symposium in Sarasota, December 1st to 3rd, you're going to get a chance to learn from all of these people in person, see what they have to say, get the updated insights, and basically ask them your questions face to face. So we'd love to see you there. It's at the Ritz-Carlton, Sarasota, and we'll get a link dropped in there if you want to go to Sarasota, MMS, or just moneyshow.com. So with that out of the way, want to introduce my guests here. We've got Jason Bodner with Money Flows. We've got Jim Bianca with Bianca Research. We've got Larry McDonald, Bear Traps Report, and others. A great book that he recently put out. We'll definitely get a chance to talk about some of the things. And there you go. Look, you got a visual prop. I love it. And Mish Schneider with MarketGauge, one of our longtime speakers at Money Show. We're glad to have her as well. I want to kick it off, I guess, Jason, let's start with you. What are you seeing in your world in terms of money flows? What are you seeing in this market? We got past the government shutdown that, lasted so long, but it seemed like the markets were able to just sort of move past it. And now that it looks like this thing is finally over, here we go again. But I think, it's kind of interesting. It seems like in the last couple of days, things like tech have been lagging a little bit, whereas other sectors seem to have been rallying the strongest out of the shutdown. So I wanted to get your take on that and just what you're seeing.
Sure. Yeah. Thanks for having me, and thanks for that introduction. If it's okay, I can share my screen and sort of walk you through what I'm seeing.
Yeah, please do.
We get a thumbs up. Good. We got Clarence. All right, let's go into it. We're looking at the Money Flows portal, and I think it's really important for anybody out there who doesn't know me. We look at the market through a unique lens, looking at unusually large institutional money flows in and out of the market with a proprietary algorithm that allows us to look day by day and not wait 3 months for delayed 13F filings and things like that. That gives us a real advantage to really understand what's underpinning market movements and pivot points. And to your point, Mike, we've been seeing a softening. This amber line is one of our most popular indicators called the Big Money Index. And what we do is we take all unusual inflows and outflows and we smooth it on a 25-day moving average. And it's very clear to see money has been moving out of the market while this blue line, the SPY, has been rising. So the S&P 500 tracking ETF is going up and money's flowing out. The encouraging sign that we're seeing right here is we kind of bottomed out, and all of a sudden we just started the first signs of money flows in. Now, that is good because from a historical perspective, November is the strongest month of the year. Going back since 1990, our data says about 74% of Novembers are positive with an average gain of 2.5% on the S&P 500. So let's hope history repeats itself. The odds at least are in our favor. And another thing, if we look at over here, is we can see these red lines are a cumulative number of unusual outflows in a day. And it's been elevated for a couple of weeks, but all of a sudden it's gone away. And now we're starting to see inflows again. If this trend does continue, I can see a bullish run leaning into the seasonality that we're seeing. But as recently as a couple of days ago, the data was looking far weaker. And to your point, there's still been rotations out of technology. And if we look on the sector level, we see that we're seeing strength in healthcare, in energy. And if we look at this over, say, the past 2 weeks, and then I'll, quietly bow out so other people can weigh in. I don't want to monopolize the conversation, but the inflows have been moving into healthcare Also technology and industrials, which I like. These are typically bullish sectors. They're laden with growth stocks. If we look at where the outflows have been moving out of, there has been a rotation out of tech. So on the technology level, money's rotating within the sector. It's a bit of a washing machine. Discretionary is weak, which I don't really love because that is a bullish sector. So we're getting some mixed messages under the surface. But the last thing I will leave you with, and let me stop sharing my screen, is that despite all this sort of congestion zone that we're seeing in the market, and we've all felt the volatility, and metals are down and metals are up and tech's down, earnings are working. According to FactSet for the third quarter reporting, which is going on now, 91% of the S&P 500 has reported. 82% of the S&P 500 has beat earnings, and 77% have beat sales. So while some companies are, kind of downbeat on their guidance or whatever, companies are still trouncing estimates by a mile. And we have a lot of macroeconomic tailwinds, which I can go into later. But that's pretty much what I'm seeing right now.
All right, perfect. Thanks, Jason. Macroeconomics, Fed policy, the sort of operating in the fog like we have been doing with government data missing. Jim, I want to pivot to you and just kind of get your, couple of minutes lay of the land here, what you're seeing with the impact or lack thereof and the shutdown, sort of what's happening. I mean, today gold's having a great day because of the whole Bostic news, I'm guessing. Where do you think things stand from that big picture standpoint?
First of all, I like this format. Can I take Larry McDonald for the block, or am I dating myself on that statement?
Hollywood Squares, there you go.
Yeah, exactly. So you're just as old as me. So as far as the lay of the land goes, you're right. We don't have the government data to look at. And so that's always been a constant, whether or not it is right or wrong. It's, if I'll use a baseball metaphor, it's like the umpire maybe calling the high strike. As long as he always calls it, it's okay. If he doesn't call it sometimes. So we're now turning to alternative data. And the alternative data is all over the place right now. Jason just mentioned the FactSet data. If you go with alternative data, what do companies say? The economy's great if you ask companies, because the third quarter numbers are looking really strong. But if you start looking at some of the labor market data, it's everywhere right now. I could give you some statistics like out of ADP's weekly numbers or Ravello or some of the others that said that job growth is horrible. I could give you just statistics, or maybe Challenger Gray and Christmas with the layoffs. I could give you other statistics that say it's great as well. So it's a bit of a confusion because we're not used to using this data. How's it really impacted the market? In two ways. Interest rates largely have been trending sideways for the last, several weeks. I think they're kind of waiting for some clarity. The Federal Reserve is not providing any clarity at all because the latest reporting that we're seeing from them is they're fractured. That was the word that Nick Timiraos used in the Wall Street Journal today. Yep. And they haven't been able to make up their mind as to what they want to do next. Inflation has been kind of in a holding pattern as well, too. So this market's been winding itself up, trying to figure out what the next step is. Stock market, more of the same. If you bust up the stock market into two broad categories, AI, non-AI. Non-AI has not been doing a whole lot this year. It's only up about, we've broken it out that way. It's only up about 7.5% for the year, whereas AI stocks are up about in the high 20s, and that's how you wind up with the S&P up, 15, 17%. Or wherever it is at this moment. So it's been a bit of a mixed bag, but I think that even within that mixed bag, any kind of extreme call on the market, oh, it's falling apart, the economy's falling apart, is misplaced. Oh, it's great, the economy's great, is also misplaced. Yeah, the companies reported very strong numbers, but remember, those are backward looking. Through September 30th, they reported good numbers. The question is October 1st forward, and we're in the middle of November right now. What are they going to be seeing? And that's an open question.
Got it. Appreciate that, Jim. Larry, I want to pivot to you because I know when you spoke for us back in the summer in Las Vegas, a lot of what you had to say was focused on hard assets and how we're going to have this big transitionary move towards that part of the market, that part of the asset world. Are you still, I mean, any updated thoughts on that? Obviously, things like gold had a huge run up, a pullback. Now we seem to be trending higher again. I'm just kind of curious what's going on in that part of the world, and anything else you'd want to share on the big picture as well.
Okay. Well, thank you, both Jason and Jim, thank you for those comments. And I think it lines up with some of the things that we're seeing. So on the gold silver ratio, we had a huge breakout today for silver. Take Hecla Mining, for example, close to a 24% drawdown and now a new high a month later. That's a really strong bull market. The gold silver ratio is breaking through 80. Typically in a commodity bull market that's led first by gold, that gold silver ratio should be down in the 50s or 60s, as it has been in previous cycles, especially during an easing cycle. The last two big easing cycles, the gold silver ratio is in the high 50s or low 60s. So we're seeing institutional clients. We run a chat behind me with hedge funds, mutual funds, and pension funds in more than 20 countries, and we triangulate the information of what they're talking about. And that move toward hard assets is broadened out toward not just copper names, but the coal names, some of the tax loss plays in the coal space and natural gas, getting a great bid this week, last 2 weeks. Really bullish AI stories there, which we can talk about in Sarasota. The best trades, I think, in the next 12 months are going to be in that gas and coal space that are going to really power AI. If you believe Jensen and the sales pitch and the pump master himself, if you believe half of what he says at NVIDIA, the coal and natural gas equities pretty much have to double or triple. And we saw with CoreWeave this week, big infrastructure problems in AI, right? So you've got bottlenecks on energy, you have infrastructure problems, you've got green protests in some cities and some counties around the stress level that electricity prices because of these billionaires and the capex spending on AI. It's really going to create some even more inequality. And so a lot of these things are big pushbacks to the trades that worked in 2025. Everyone's looking at the chips. It's really yesterday's trade. The new trade is really, the power sector and how we're going to get to that next level on AI. And I just want to remind people, most importantly, part of this conversation, there's 31 trillion in the NASDAQ 100 today. In April, there was 21 trillion in the NASDAQ 100. So 31 trillion today, 31.5, 21.5 in April. And in January of 2023, at the end of that kind of 22 bear market, we were down at 12 trillion in the NASDAQ 100. So it's gone from 12 trillion in 2023 in January to 21, so 12 to 21 in April of this year, and now 31 trillion. And so what we're seeing, and it lines up with what Jason and Jim were saying around, especially what Jason was saying around the tertiary, so the weaker parts of the market. So look at CMG today, up 3 or 4%. That rotation out of tech, out of what's working into beaten down tax loss plays, your Adobes, your ODFLs. There's some phenomenal Target. Look at Target versus Walmart today. We're seeing a really colossal rotation out of what's working, and out of that 31 trillion, if 2 or 3 or 4 trillion bucks leaves the NASDAQ 100, the rest of the market is so cheap. You go into tax loss. By the way, that should peak out right around next week or the week after. But we get that, and then you get that seasonal play into the new year.
Well, there's a lot to unpack, and I'm definitely going to circle back to you, but I want to make sure everybody gets the chance to sort of set the stage with what they're seeing. So, Mish, I'm going to pivot to you. I know you were kind of nodding your head during some of those comments on commodities. Obviously, some of the notes you sent me pertain to energy. So, what are you seeing? Take a couple minutes, kind of outline what you see, whether it's equities, commodities, or a little bit of everything.
Well, yes, and thank you, because my esteemed co-panelists actually touched upon so many things that we've been thinking about and trading upon. So let me see if I can kind of do this a little bit differently to add context. These are the things that can't happen. Let's put it that way. So picking up on Jason, for example, talking about the discretionary spending, that whole consumer sector has been weak, staples as well. And what we cannot see, one of my favorite expressions this year is a weak link become an anchor. And certainly the consumer would be a part of that. And if you really want to get specific, we like to look at XRT as the ETF because of its blend of both staples and discretionary. It's been 25 days under the 50-day moving average, if we want to put some chart on it, and 200-day moving average actually held last week on the weakness. So it's agnostic right here. Transportation would be another sector. It's actually doing relatively well, partly because it responded to Lyft and Uber. But that too has to stay in the game because that's so key, a key U.S.-centric sector in terms of really being able to measure growth of the economy. So those two specifically have to stay in the game. Small caps is actually doing a pretty good job, so we're okay there. What else can't happen? We can't see interest rates go up. At this point, we're hoping whatever the spike was after the last Fed meeting in yields is the top. And if anything, we want to see that come down, regardless of whether or not what the Fed does in December. I think you really have to keep your eye on the TLTs in particular. They have been in a range between like 85 and 92. And right now they're back over 90. So certainly, to me, it seems the implication, or at least the tendency, is going to be towards lower yields. That's good. And of course, that's also bad. We can't see inflation really getting much higher here. So it's great, Larry, that you talked exactly what I write about all the time, which is the gold to silver ratio. I'm an old commodities trader from a long time ago. And we know in 1979, 1980, that ratio went all the way down to about 24, which is extraordinary. It didn't stay there. But after it peaked this year at 115 and then went all the way down to about 78, 79, and then went back up to 85 on the correction of gold and silver. Once that 85 started to flip over, we bought silver. And exactly what Larry said is that one of my trifecta of inflation indicators, of course, would be that gold to silver ratio. And if silver really starts to rally more from here, and it's already close to all-time highs, and that ratio breaks down under 78, sign. Dollar really hasn't been very key. It's in a range also. But if that breaks down, second sign. Third sign is the agriculturals, particularly sugar, which really hasn't been all that great this year, but yet could be basing here, which is more of a social unrest indicator for me. And then I guess we have to throw in oil. We back above $62 a barrel when we're talking about West Texas, and hold, because that too can be a spike for inflation. And I'd say all of those things are really the keys to watch right here in terms of AI and what's happening with infrastructure and the huge capex, and of course the bubble bursting. We don't want to see that bubble burst either. It's okay to see the rotation like Larry was talking about. That would be healthy. But an actual real bubble probably would not.
Got it. I have so many questions that kind of pop up when everybody's speaking, so I definitely want to get to those. But I do want to say, Gav, I mean, you host so many of these spaces. You have so many great guests. You hear all kinds of perspectives from the people you have on. Yeah, anything that you'd sort of synthesize or summarize as far as what you're hearing and the people that are coming on your shows, and what are they seeing in this market?
Yeah, definitely. I mean, I think that the main overall mindset that we get from a lot of the folks on our shows is consistent messages, and these have been going on for years. Don't fight the Fed. The trend is your friend. All-time highs are not bearish, right? You kind of take those three things and you put them together. I thought there's a lot of great points that have been shared on here, specifically about where, Jason, you were showing, money starting to leave the market, some of these other pieces. I think that those are all important things that we try to incorporate into the shows because people are pretty bullish, right? They've had a couple years of bullishness. I think that retail has rewired their mindset a little bit when they see the fear and greed scale dip into fear. They actually are buying more now in those areas and continuing to push forward with them. When we come off the earnings that we just saw, and those were mentioned as well, the earnings are very strong in those areas, and they see NVIDIA and so much CapEx going. I think that the main thing that I am seeing that's kind of new that has become a bit of a bigger focus is especially over the last few months, people leaning into the picks and shovels plays of energy, of power, of AI, and trying to figure out, okay, there's hundreds of billions of dollars being spent in CapEx. Where's that money going to go to? Because these large, mega caps, right? Like you have NVIDIA at 4.5, 5 trillion. Like that's crazy, but that's not going to be a commonplace thing in this area. There's going to be companies, maybe they'll have the chance to go up 50 to 100% over these next few years. But if you can find those picks and shovels plays and there's a company that gets a massive contract, they'll get a huge opportunity. So I think that specifically the two areas for me have been the picks and shovels plays of AI, such as cooling systems, right? And other items like that. Like people don't realize 30% of the CapEx right now is spent on cooling systems for the machinery, and then on power and electricity, because I think that that's going to be just in massive, massive demand. So those are two thematics that have really risen up lately.
Okay, great. Appreciate that. As a reminder, again, if you're watching this, we do have the Sarasota Money Show Symposium coming up December 1st to 3rd. We'll pop that link in there again. Register, join us. We're at the Ritz-Carlton this year. Should be a great time. Actually, had our first cold snap here in Southwest Florida. It was 38 when I woke up the other day. I was like, wait a minute, is this Chicago? What are we doing? But yeah,
That's
man,
not cold.
I was going to say, I mean, you have no sympathy for me, Jim, and I completely understand that. I'm going to actually go to you next, Jim, because, we have this Bostic move at the Fed. We have, the Timorous article kind of setting up the stage for will they or won't they for the December meeting. And then, of course, next year, Powell's going to be sort of riding off into the sunset. And that raises a lot of interesting questions about what the Fed may do on a policy front, regardless of what the data shows. So I'm just kind of curious if you can unpack that, put your crystal, your sort of future seeing hat on, and tell me what you think the Fed's going to do and what it means.
I think there's a big change underway at the Fed, and it's a long time in coming, and I'm welcoming it. Back in 1986, there is a famous story from 1986 that Paul Volcker did not want to cut interest rates, and the board overruled him and voted to cut interest rates, and he immediately resigned in the middle of the meeting. They talked to him to come back into the boardroom 10 minutes later. They had a second vote, and they didn't cut rates because they didn't want him to resign. And from that moment forward, the Fed has operated under the idea that the Federal Reserve Chairman gets what he wants. He makes the decision. Everybody falls in the line. Yeah. I think that that's finally starting to end. I think that they're starting to act like 12 independent voters right now. Maybe it's because Trump has been hammering them. I think actually it might be because Trump has been hammering them. And what you're seeing now with the fracturing in the Fed is a good thing. You've got some big questions that no one has answers to. Inflation is going to go up because of tariffs. Is that going to be a one-time effect, or is it going to be a lingering effect? How many jobs does the U.S. economy need to make, considering that the population growth is way down because of no more immigration? I mean, these are the types of questions that we're starting to struggle with. What is the neutral interest rate? Are we at it, or is it lower or higher than where we should go? I think what you're going to see, remember the last meeting you had 10 voters that voted in favor of policy. One voted to cut rates 50 basis points, and another one voted to not cut rates at all. I wouldn't be surprised if we start getting down to 7 or 8 voters voting for the policy, 4 or 5 voters voting against the policy. That wouldn't be unusual. We have 5-4 votes all the time at the Bank of Japan. We just had a 4-4-1 vote at the Bank of England in August. So this is where I think the Fed's going to go. I think we need to start to understand that the chairman may be losing his power, and that's not a bad thing. These are difficult questions to answer. That's why we have a board. That's why we have a committee. They're supposed to bring their own expertise instead of just waiting for the chairman to tell them what to do. And I hope that that's the case. Now, what do I think they're going to do? I think they're going to cut rates in December. I wouldn't. I would vote against it. But they probably are going to cut rates in December. I think at this point, I think it's a very, very close call. As the government reopens and as we get some data, if any strength comes in any of that data, I think that will be called into question.
Thank you, Jim. Larry, I want to go to you and talk a little bit about this AI issue. And then this is going to be something I think everybody can maybe weigh in on as well. The AI boom, AI bubble, is it .com all over again? Is it not? Sort of what is your take on what's going on out there, the circular deals that we see? Is this just sort of the nature of this boom, or is this something that is more problematic and something we have to really worry about as we get into the new year?
Well, the bottom line is it's a testosterone, pump contest in Silicon Valley, right? Where these guys have gone stark raving mad. I mean, to the point where Meta reports earnings, right? For you to do a $30 billion fly-by investment grade bond deal. And what that means in English is that you didn't prepare the street, right? If you're going to sell $30 billion of paper, you don't do it overnight. And the reason they did it that fast is that something happened inside the company to really freak them out to the point where they had to sell. Remember, they told us a year ago, free cash flow is going to pay for this whole AI boom, right? Oh, by the way, that's not the case anymore. And you see, that's why credit default swaps are blowing out on CoreWeave, and Oracle's now down, I think, 34% off the highs. And so you've got this really kind of nasty surprise on the credit front where 47 billion of paper came from Meta and Google in a very short period of time. In the history of, remember, I co-founded ConvertBond.com in the 90s. We were lucky enough to sell it to Morgan Stanley. It was a great, great trade. But one thing we've seen over the years is that in every cycle, there's a sector that kind of levers up and is really healthy. Think of energy 2010 to 2014. Really healthy, levers up in the shale space, and you got investment grade companies that become junk. Same thing with the dot-com era. Same thing with multiple times. Same thing with the financials, 2003 to 2008, right? Very healthy financials. They're all levered up off balance sheet. Next thing you know, lots of downgrades in the financial crisis. The same thing's happening here. It's testosterone. It's hubris. Look at CoreWeave, $60 billion enterprise value, right? 60 billion enterprise value, 16 billion of negative free cash flow, right? Negative free cash flow with 18 billion of debt. All that means in English is that you've got that's almost an insolvent company. They're just burning so much cash. They're not producing enough free cash flow. I can give you 3 companies. So that's a 60 billion enterprise value at CoreWeave, right? And I can give you 3 companies in the natural gas space and the coal space combined with like Range Resources and Taro and Core Natural Resources, right? Combined market cap of $25 billion. So it's less than half of CoreWeave, and free cash flow yield on those 3 companies that are huge AI players, huge the next 5 years, free cash flow yield of literally more than 10%. So free cash flow relative to the market cap close to $3 billion. So 25 billion, maybe close to $3 billion free cash flow yield on those 3 stocks. And that's looking out to 2026. So the bottom line is, we have a credit crisis that's coming at us from private credit and from this whole AI build out that just needs a lot more cash. And there's a lot better balance sheets in the coal and natural gas space.
Yeah. Thanks, Larry. Mish, I wanted to go to you because Larry brought up one of the companies. I actually made it the chart of the day for a piece I did the other day, and that was Oracle. I mean, we know what happened in September, huge news, and there's enormous numbers in terms of their future contract backlog, revenue, whatever. Stock had its best day since 1992. And all it's done since that day basically is sort of chop lower to the point that it basically traded back to where it was. And now I think Larry Ellison was richer than Elon Musk for like a day or two there. And now he's lost some of that. So I want to know from a technical perspective, what are you seeing in that sector? And then Jason, I'm actually going to have you weigh in as well after Mish is done.
Well, in terms from the fundamental standpoint first, there has been that chart that went around showing the nepotism, if you will, of how concentrated the major companies are and the little companies that are getting involved, some of which are predicted won't even be in business in a year from now. Now, I'm not saying that wouldn't necessarily happen to Oracle, but I think there's a few that we can look at that probably will not survive. That's probably the closest parallel to the dot-com bubble, but it has nothing to do with the dot-com bubble. Basically, what I'm seeing is this. There's an evolution that's happening. And what's amazing is that I feel like we're watching evolution unfold, all of us as human beings. On the one hand, and again, I know you asked me about the technical, so we'll go there in a moment. Sure. But on the one hand, you've got people losing their jobs because of AI. And I have somebody working with me now who was definitely one of those who got completely X'd from the film industry in New Mexico, which was huge. 20 years in post-production, job replaced by AI. But what these people are doing, and what I saw when I was in New York speaking to a lot of people under 35, is they're creating new opportunities because of AI. And that's where I'm seeing the evolution. So there's no doubt that we are in a whole new world, and that world will continue to expand. In terms of just looking at the space, I think right now we have to watch the semiconductors, in particular SMH again, is what I like to look at. And after making new highs and coming off, I think right now, if it breaks down under 340, is it 300? You know, sometimes I get in, if I'm not looking at the numbers directly.
No worries.
Let me put up a chart of SMH here. Hold on. So basically, whatever, I think it's either 240 or 340. It's so hard for me to remember, but because I look at so many different prices. Hold on, I got it right here. Yeah, I was right, 340. Okay, so I just wanted to make sure that I was right about that. If that breaks down and we start to break down under the 50, I think that will pull the whole market down. At this point now, I think we can certainly afford to see some selling coming out and some sort of regathering of the winners versus the losers. And it really, again, going back to what happens with commodities, particularly infrastructure. Another one of my favorite expressions this year is all energy hands on deck. Natural gas being one. Obviously, we've seen solar have an incredible explosion lately. And then, of course, what happens with oil and coal has done well. And then what happens with the whole power space, nuclear, which got a little bit ahead of itself, but still has a future. I think all of these things create an issue, but not necessarily the end. And if anything, I would be looking for a major dip in any of the stronger companies as a buy opportunity.
Perfect. Thanks, Mish. Jason, to pivot to what you said earlier, you were talking about kind of how there was some rotation, washing machine type action in the tech sector. I'm wondering, is that money coming out of the subsector of AI stocks into another part of tech? Is it money coming out of tech and moving into some of these other ways to play the AI move, whether it's utilities, whether it's energy, nat gas, that kind of thing? I'm just curious as to, whether you're seeing that, and if so or if not, what your thoughts are on that move.
Sure. Let me share my screen again, because basically we like to let the data speak for us no matter what. And I just want to clarify, I'm actually bullish. I'm not too scared of the AI trade. I don't liken it to a bubble. I've seen media comparisons to the 1990s run up to the, .com crash. That was so different. Those were companies that had infinite price to earnings multiple because they had zero earnings, zero sales. And a lot of them were just, it was the, shooting fish in a bucket, trying to get the unicorn trade. Whereas these days, I just explained to you on the S&P 500, 82% of companies are beating sales. And what was it? 76% were beating earnings, something like that. 77. So, this is driven by earnings expansion, and we're having some of the best earnings runs in a while. And while it's true, we got to see what happens from October forward. I don't think everything's just going to come screeching to a halt. But as far as what we're seeing in tech, right now, tech is still my second top ranked sector. And in the money flow world, we look at inflows and we also look at fundamentals. So if I'm going to look at the tech sector, first, we're going to see this nice picture of overall way more green than red. Yes, we get a little bit of red here, meaning outflows. That's that rotation we were talking about. But overall, this pales in comparison to, the April, Liberation Day. That was terrible. And if I go back to 2022, it was just a miserable period. This looks like virtually nothing. So I'm not particularly alarmed. In terms of what's been happening, you're seeing inflows just a day ago, November 10th, into phenomenal equities. These were the actual tech stocks that saw inflows as of the close on 10th, Micron. And all you have to do over here is look at the fundamental scores. For us, a fundamental score between 70 and 85 is a really great sweet spot. You're just seeing money flowing into a lot of strength. Sure, there's a couple of technically extended companies with fundamental weakness like Frog. I don't even know what they do. But overall, we're seeing money flowing into tech. And to Mish's point, the chips, look at those inflows lifting Micron. I mean, that's huge. Over here is when it appears on our top 20 research. That's our creme de la creme. As a quick caveat, Professor Bessenbinder in 2017 posed a simple question: do stocks outperform treasury bills? And he looked over 100 years, and spoiler alert, he found only 4% of stocks account for 100% of the gains over bonds since 1926. So all it means is you got to be in the right stocks. And I'm a growth investor. I'm constantly looking, at companies that are, no offense to Larry, I don't even look at companies bloated with debt, issuing paper, shrinking earnings, shrinking sales. I want nothing to do with those. They may be great turnaround stories in the future, but I want the ones that are firing on all cylinders right now. And again, to Mish's point, if we go and we look up SMASH, SMH in our ETF world here, look at all those inflows. I don't see any outflows. And this pullback from the high is barely a hiccup. And if we go and we look at the constituents, obviously NVIDIA is 18.2% of the ETF. That's driving a lot of that growth. Lam Research, a company that I've owned for a long time, Broadcom, KLAC, Empower, these are just terrific companies. Each one, if I click in any one randomly, Empower, we're going to look at their sales and earnings growth. 1 year growth of 21%, 3 year sales growth 23%, 1 year EPS growth of 17%, 3 year EPS growth of 126, a profit margin of 81%. They all look like this. So, it's driven by growth, by actual growth, by actual metrics. So I'm not afraid of the big bad wolf is what I'm saying. I still like to.
That's a nice way of putting it. We got some good metaphors. The big bad wolf, the washing machine. I mean, Jim referenced game shows here. This is great. Gav, I want to ask you again, because, you got your finger on sort of the pulse of the retail investor given in the world you operate. And is there a lot of bull bear debate going on there? People kind of yelling back and forth, or is it, do you tend to think people are really on this and not this train, whether it's AI or some of these other, AI derivatives, and not worried? I'm just kind of curious as to what you hear on that score, sentiment wise, I guess.
Yeah, it's a great question. You definitely have the people who are kind of the perma bears, right? Like those have been there. And to be honest, shout out to them for staying strong throughout these last couple of years, because I can only imagine what that's taken. So there's definitely a couple of those perma bears there. But yes, I think for the most part, a lot of people, most of retail, obviously everyone that's on here has been investing for far longer, but most of our retail audiences really were cultivated out of the 2020 pandemic, right? I think that's people were lightly investing beforehand, but they took it more seriously. Maybe they started to get involved with some individual single stocks and other items like that along the lines there. Then they had 2022 happen, and I think a lot of them got kind of crushed, right? Like all these stocks would, I went out and did my individual research and it's down 98%. And so you had people pull into, I think in a large part at the end of 22, into index funds, broad-based index funds. And so a lot of those people have really reaped the rewards of that over the last couple of years, right? They're up 40, 50% in a couple of years. And now I think they're starting to creep back into, okay, well, let me take a look at NBIS. Let me take a look at IRIN, right? Look at the NVIDIA. Look at what these individual stocks are doing. So I actually think you're coming back into the part of the cycle, which worries me a little bit, right? When you see this move back in where people move to the index funds, now they're seeing the gains that are happening in individual stocks. They're moving back to some of those individual stocks. And I do wonder if that is also creating a little bit of terror for people. And now you see more bears creeping back in because they're like, oh, that individual stock that you like, look at Meta, right? Look at this, right? You just had a 10, 20% drawdown quickly. And if we'll see that retrace back into the index fund. So I would say right now, the splits are pretty vast, probably like an 85% bull split at this moment. I think you have a couple of people that come in. The ones that are bears, even if they are bears, I think have to be very tactical right now. on where they're talking about being bearishness, specific areas, or they're short-term, right? They're moving within the market areas, things along those lines. But yeah, the lean of retail is very bullish. And I think that for most people, they look at it and they say, hey, the Fed's going to keep on printing. And I believe it was Jim who had some good comments about the Fed and how things are shifting there. And I do agree with you. Maybe they shouldn't do a rate cut, but they are probably going to do a rate cut. And so retail sees continued printing, rate cuts, right? An environment where the Trump administration is trying to provide stimulus, right? A $2,000 tariff checks coming in. And people look at it and say, like, it's very difficult to be bearish as a retail investor in that environment, especially when you're not looking at perhaps more in-depth data sets that could suggest other things.
Yeah, so we could be back to Stimmy check 2 here or something, huh? Or I guess 4. I don't know what number we're on at this point if it happens.
Watch those Robin Hood accounts.
There you go. Jim, I want to ask you, you're going to be speaking on sort of this 4, 5, 6 world when it comes to returns. But I thought it was an interesting point Gav brought up about retail being trained to expect more. We had 24% year from the S&P, a 25% year, now give or take 17%. Is that something that worries you, or do you think this is just what bull markets look like, and maybe for a while those higher returns are going to be the reality we can count on?
First of all, if we're going to go stimmy checks, you have to use Roman numerals like the Super Bowl. So keep in mind that's the way you got to do them properly. You're right. I've been arguing about the 4, 5, 6 markets. What I mean by that is that going forward from here, I think that cash is going to return you around 4. Bonds are going to return you around 5. Now, the stock market returning you around 6. Well, first of all, 4 and 5 is largely what's been happening. I mean, the bond market's a little bit ahead. It's up about, like the broad aggregate indexes are up around 7% for the year. So they're a little bit ahead of that for right now. Cash is around 4. Stocks is an interesting question. You brought up like the S&P's up 17%. I use the statistics that Michael Kemblis at JP Morgan put out, where he said, here's the 41 AI and AI adjacent stocks in the S&P. These are the AI stocks, the Mag 7, the power companies, a couple of the capital equipment companies. Yeah. We take them out. If you take them out, the stock market is up about 7% ex AI. You add in the AI companies and it's up 17%, the S&P. So about 2/3 of the gains in the stock market has been AI related. So that 4, 5, 6, it's sort of kind of working, but you're right. The reason I was talking about that was as a metric of expectations. You can't be expecting the market to continue to pump out 20% gains a year. It has for the last couple of years. I know the index will, but that's also because you've got this AI play in there. But the rest of the stock market is probably in the mid to high single digits. And I think that that's what you should be expecting going forward. Now, after that, that doesn't mean that there isn't idiosyncratic ideas or specific themes or stocks that you could do better with. Of course, there always will be. But as far as the asset classes go, given the valuations and given where we are, you've got basically, I'll stick with, you got 4, 5, 6 plus AI, whatever AI winds up doing from here. Can I make a quick word about AI? The issue I see with AI is Brian Taylor over at Global Financial has 200 years of data. Michael Kemblis, let me back up. Michael Kemblis's argument is that 41 stocks in the S&P are AI related. They are 48% of the market cap. They are half the stock market is AI. When was the last time half the stock market was one theme? Brian Taylor's data at Global Financial, which he's got 200 years of data, is arguing late 19th century railroads. That's the last time we saw the stock market this concentrated within one theme. What is the theme? What is the pattern you see over and over again? Not that any one of these companies is overvalued tremendously. Yeah, maybe Tesla is, maybe Palantir is, as some examples. Yeah. But that everybody prices everything to do with AI as winning. Everything's going to win. We did that with the internet stocks back in 2000. You put .com on the end of your name and the stock market, your stock tripled in price. Not everybody's going to win. And there's going to be a massive overbuild is what you're going to have with AI. So what you're going to be left with, kind of like you did in 2002, is that you were left with a lot of wreckage in the investments of internet, but with a functional internet itself. If we're not careful, we're going to be left with a lot of wreckage in the investment of AI, but we will have AI itself because of the massive overbuild. So the problem is, we saw this with the railroads. There was more railroad tracks laid by 1900 than humanity will ever need to use. And the next time they were used is when we tore up a lot of it. There's more fiber optic cable laid by 2000 than humanity will ever use. And I would argue that by about 2028, 2029, there's going to be more data centers than humanity will ever need at that point. And a lot of these data centers might never even be
where's the power for the data centers to do? There's no power.
Don't worry, they're not going to be used. They're not going to be
When your
used.
electricity bill is $1,000 a month, I guess that's where it comes from, right?
Right.
Yeah,
Well, that's the
yeah.
point. That's the point. They're not going to be used. We're going to build a data center and it's never going to be used. And so this is the massive overbuild that we're seeing. But you're right. As far as the power usage goes, that's going to be a big problem, because right now affordability in Washington is one of the big topics. And Mikey Sherrill won in New Jersey saying she was going to freeze electricity bills. And that was very, very popular. So Washington is of the opinion that the AI data centers, they're just not going to get power. They're just not going to get it, because if it means electric bills go up, turn them off. And that's what really the fear that you're going to have with that right now. Oh, build a power center to build a power plant to fund to power these things. That's going to take 5 to 8 years. They don't want these things turned on in the mid 2030s. They want them turned on next year. So this is going to be the push-pull that they're going to have. But again, it's about the massive overbuild. We saw this with AI. We saw this with railroads. This is something that we saw this with television. We saw this with radio. We saw this with PCs in the early 80s as well, too.
Yeah. I'd love to continue the AI discussion, but I want, with about 10 minutes left in here, one thing we haven't covered really is the world of digital assets, crypto. Charlie was unfortunately unable to join us. I don't know if there's anybody who, on this panel who kind of wants to weigh in a little bit in that space, sort of what you're seeing there, comparing maybe what's happened in the crypto universe to the gains that we've seen on it from an investment standpoint in gold, silver, real gold versus digital gold is sort of the old trope. Anything anybody wants to weigh in on that?
I would just say,
Go ahead, Gav.
most of our clients are
Oh, Larry, I'm
pension
sorry.
funds. Can you hear me?
Larry,
What's
your
that, Larry?
sound's
You're cutting out a little bit there.
a little bit off. Yeah. Is a service again.
Go ahead,
Yeah,
Mish,
Larry.
while he gets it worked out.
Well, yeah, I mean, there's a couple of things that are buzzing around that space right now. One, of course, is the SEC versus the CFTC, and who's ultimately going to be the governing body. I know that people in the crypto space are looking into that. CFTC, of course, would be more commodity-based, and looking at cryptos as a commodity is something that I don't find particularly surprising. I don't know if it's going to make much of a difference who's the governing body. So that's number one. Number two is, Tether announcing now that they're really looking at gold as the backing for their stable coins, which is another interesting shift and obviously very positive for gold. And then if you're just looking at the currencies themselves, talk about your generation, Gav. How many times have I been on spaces where I'm listening to them talking about just keep buying the dips, keep buying the dips, keep compounding. Like there's never going to be a market that goes down or goes sideways, which those of us on the bottom part of the panel are old enough to remember can happen for a long, long time. Risk management, right? So that's what we're seeing in Bitcoin. There's been a tremendous amount of cash outflow, people getting really burnt buying Bitcoin when it was up at 108, 110, thinking it was going to 150. You get these calls for 250,000. So I think right now what you really have to look at in the Bitcoin space is functionality. And I love to look at the things that I find the most functional going forward. And it's very highly technical, by the way, but it would be Chainlink, it would be Ripple, it would be Ethereum, it would be Solana, those in particular. So I'm still very bullish in this space. But it's like everything else. You have to have a level of risk management, and you have to think more actively investing if you're just getting involved now, as opposed to people I talk to who say, oh, yeah, I've had Bitcoin since it was like $10. You don't meet too many people like that.
Well, if you do, you want to stay friends with them, that's for sure.
We've seen a lot of outflows from specifically last week. we saw outflows in the following ETFs. There was the ProShares Bitcoin ETF, the iShares Bitcoin Trust, Ethereum, Bitcoin for Grayscale, ARC's Bitcoin, iShares Ethereum. There was just outflow after outflow in the
Bitmart, that's another one. Tom Lee and his whole thing.
Yeah, and I suspect actually that the crypto market had some influence on the equity market's volatility. You know, we've heard the stories, we've read them where platforms are basically saying, oopsie, you're having margin calls, and guys are getting literally wiped out and taken to the woodshed.
Yeah.
And unless they're 100% all in on crypto, they probably have to finance a wipeout with selling some equities. So I do think when you get those pivot points and extreme leverage moments where people are literally getting carried out, there's pressure in the equity markets because people need to raise capital. Now, for right now, that seems behind us. Obviously, crypto is under a little bit of pressure today. I'm not a huge crypto guy. I look at stocks. Do you make money? Do you make sales? Can I quantify all that? With crypto, there's a lot of application and story, and I do believe there's a strong future for it. But much to Jim's point, I think in no other market are we going to see a handful of winners and a littered graveyard of losers than in the crypto market. So,
yeah, Jim, I definitely find the Tether story fascinating. That you've got, you know, this stable coin where they're out there, they're buying gold hand over fist. Was like a ton of gold a week or something. They're accumulating it faster than most central banks are doing it, and yet obviously its role is to facilitate transactions in the crypto world. Any thoughts on that, or any thoughts on as Jason brought up that Friday, Saturday period where we had a really nasty liquidation in crypto not too long ago?
I have some thoughts, but they're in a slightly different area. If you want to go first, Jim.
Yeah, I was going to go a little bit different too. You know, you mentioned stable coins. I was just going to say just a big picture thing. I think the biggest issue that we face with crypto right now is, what is it we're trying to do? Are we trying to build an alternative financial system? Are we trying to replace the New York Stock Exchange with Uniswap? Are we trying to, replace the currency with Bitcoin or with Ethereum? If that's what we're trying to go, I'm worried that we're not going about it the right way. This is going to be antithetical to having government regulation and oversight by the SEC, CFTC, or the Treasury or the Fed, because this is going to replace them and put them out of business. That's really what it should be. If it's going to get enveloped into the current system, and that seems to be the way that everybody's going, yay, we passed this Genius Act, and and everybody's getting excited with it. Okay, fine, let's just run it all on a server at the Federal Reserve and do away with all this blockchain stuff. It's too complicated. It's much easier to do it that way. And then the Federal Reserve can permission it all it wants. It could censor it all it wants. It could decide how much Bitcoin I own, when I can buy it, when I can sell it, just like it does with dollars through the AML and KYC rules that it has right now. So the only question I would say is, what is it that we're trying to accomplish here? Are we trying to build an alternative, better, decentralized, permissionless financial system? If we are, sign me up. But if we are, you're not going to get that by having meetings at the Treasury between them, the SEC, the CFTC, and Jamie Dimon to decide how this system is going to get built. They're going to be pushed aside if we're going to build that system. And it seems like the cryptos are going for short-term gain. We want everybody in. We want to pass the Genius Act. We want to pump the coins because we're not interested in a long-term build here. We're interested in short-term gains. That would be my criticism of what I see right now.
Fair enough. Yeah, I know we're just about out of time. Oh, I'm sorry, Mish, go ahead.
Well, I was just going to say, Bitcoin is a tween. That's how I look at it. As a tween, it doesn't really know what it wants to be yet when it grows up. And I think that's exactly what Jim is saying. We don't really know. Hoping blockchain and digitalization and whoever is the governing body kind of stands out of the way and we have a free market. But you're right. We know things can get screwed up pretty easily once there's too much government involved.
Gavin, one last point you want to make before I wrap things up?
Yeah, just two things. One, I kind of see Bitcoin and the rest of the crypto world slightly different. Obviously, Bitcoin has achieved that $1 trillion market cap. It's a very different area to me, and it's been a lot more stable, trust me, than if you look at a lot of the rest of the ecosystem and what's happened there. Bitcoin's basically flat this year. It's slightly up. The rest of the ecosystem has been destroyed. Number two, I think the big thing lately that we've seen is the DATs, the digital asset treasuries. That's been a pretty fascinating move right here, where you're seeing companies that are essentially, left for dead that have now come and basically said, hey, we're buying crypto, and that's moving their price. Like today, there's one that the Winklevoss brothers did with Zcash, and the stock is up 400% today, right? Like just those moves off saying, hey, we're going to buy some crypto treasury. So that to me is like a super fascinating area. Some of them it's kind of worked with MicroStrategy, some others it hasn't, but that's a pretty interesting development.
Got it. Well, I appreciate that, Gav. Thank you. Thank you, Jason. Thank you, Mish. I know we had Jim and Larry had a little technical difficulties there at the end, but I appreciate everybody's time. If you're watching this, again, remember, you're going to get to hear from all these experts at the Sarasota Money Show Symposium we have coming up, sarasotamms.moneyshow.com. Link is up there. It goes December 1st to 3rd at the Ritz-Carlton, Sarasota. Great lineup. Really, if you're invested in stocks, you're invested in crypto, you're looking for alternative assets, you're looking for some ideas, perspectives on what you have in your existing portfolio or some new ideas for 2026. We're going to have a little bit of everything for you there. So would love to have you come and say hi, talk to our speakers in person, and get some ideas you can put to work in your portfolio. So with that, thanks again to you as well, Gav, and everybody, best of luck in your trades.
Yeah, my pleasure. Thank you to everybody who's been on here. Thank you, Jason and Mish, and the rest of the panel that we had. Appreciate you, as always, for hosting these together with me, Mike. I'm sure we'll be back on another one soon, and appreciate all the thousands of investors that tuned in and left their thoughts or insights as well. We'll see you at the Money Show.